Welcome to Rich Tribe. Society loves to sell us this idea that the ultimate secret to getting rich is to just secure a massive salary. But if you actually dig into the data, true wealth is driven by a hidden behavioral gap. It's not just about how much cash is flowing into your bank account, it's really about the internal psychological ledger you use to manage it. Let's dive right in and see what's actually keeping people broke. That is the perfect hook, Richard, because it brings us right to the million-dollar question. Literally, why is it that so many incredibly smart, hardworking people, individuals pulling in six-figure incomes, still find themselves drowning in credit card debt and staring at completely empty savings accounts at the end of every month? So what is the true cost of this lack of self-control? To answer that, Rachel, we need to look at our first principle. Section 1, the hidden wealth superpower. But hang on, surely income has to play a massive role here, right? I mean, the data clearly shows that the highest earning college graduates can pull in upwards of $2 million more over their lifetime compared to those with just a high school diploma.
Oh, it absolutely helps, Rachel. You definitely need seed capital to grow a crop, no doubt about it. But here is the millionaire's real secret. It's the absolute mastery of delayed gratification. Your early economic programming almost always overrides a high income. You could literally hand someone $2 million, but if their internal software is wired for instant gratification, that money is going to vanish overnight.
And the research perfectly illustrates why this happens. There's a massive study from the University of Pittsburgh that looked at over 12,000 adults across 61 countries. They found that having a lower childhood socioeconomic status, basically growing up with less financial security, actually mentally programs us to prefer short-term, immediate rewards. And it gets even crazier. If you grew up with less and then you experience a recent economic loss as an adult, you are statistically the most likely group to demand an immediate, smaller reward over a larger, delayed one. Your brain is literally wired for scarcity. Which perfectly brings us to part 2, the biology of impatience. So, if this is all so deeply ingrained from childhood, how on earth does the average person fight their own programming? It sounds like we're basically battling our own biology here.
We absolutely are. Just look at how this biological battleground is set up in our brains. On one side, you've got the limbic system. This is the ancient, primal part of the brain that processes emotion and just screams for instant gratification. Then on the other side, you have your prefrontal cortex. That's the sophisticated, logical center that handles planning and future consequences. So when you walk past a luxury car or some flashy new gadget, your limbic system wants it right now. Your prefrontal cortex is the only thing trying to remind you about your retirement in 20 years. And for most people, the limbic system wins hands down.
Okay, that makes total sense biologically, but how does this actually play out in a real-world financial framework? How do behavioral economists view this internal tug of war?
They look at it through this fascinating lens called the behavioral life cycle hypothesis. It was pioneered by economists like Richard Thaler and Hersh Shefrin, and it completely flips how we view personal finance.
Let's break that down in section 3, the planner versus doer. So under this hypothesis, you aren't just one purely rational human making perfect financial choices. You actually have two distinct internal personas, constantly fighting for control over your wallet. You've got the planner, who is farsighted, rational, and totally focused on building a wealthy, secure future. And then you have the doer, who is myopic, completely impulsive, and really only cares about maximizing pleasure in this exact second. And this doer manipulates our finances through something called mental accounting. See, traditional economics says a dollar is just a dollar. But in our minds, we categorize money totally differently. The impulsive doer views the cash from your monthly paycheck as highly fluid and completely spendable. But locking that exact same cash into a retirement fund, the doer perceives that as incredibly costly. It actually feels like a loss of freedom to your brain, even though you are literally just paying your future self. Okay, so the crucial point here is that we are constantly at war with this inner doer. But how do we actually know if we're losing the battle? How can we self-diagnose our own financial habits? Well, you do it by figuring out exactly which type of procrastinator you are. In behavioral finance, you're basically either a naive procrastinator or a sophisticated one. Naive people are completely blind to their own weaknesses. They tell themselves, hey, I'll spend today, but I swear I'm going to start saving tomorrow. Of course, tomorrow never actually comes, and they fall into this brutal trap of time-inconsistent overborrowing. Sophisticates, on the other hand, they look in the mirror and say, you know what, I have weak self-control. They anticipate their own preference reversals, and they actively build systems to stop their inner doer from ruining their financial future. That brings us perfectly to section 4, hyperbolic discounting and debt. I want to dig into that naive procrastinator for a second here.
What is the exact psychological mechanism that tricks them into swiping their credit card when they absolutely know they shouldn't?
It is a cognitive bias known as hyperbolic discounting. And frankly, it's the entire engine of the consumer debt industry. Here's exactly how it works. If I offer you $100 today or $150 in 1 year, your brain's limbic system aggressively demands the $100 today. You irrationally forfeit a guaranteed 50% return just because of proximity. But, and here's the crazy twist, if I offer you $100 in 5 years or $150 in 6 years, your preference completely flips. Suddenly, your rational prefrontal cortex takes over and you choose the 150, even though the math and that 1-year waiting period are exactly the same. We systematically overweight immediate rewards just because they are right in front of us.
And this isn't just theory. Hard survey data shows that just a 1 standard deviation increase in your level of impatience, meaning your tendency toward this hyperbolic discounting, leads to a 5.4% higher probability of you being a debtor and carrying credit card balances. Simply put, the more you discount the future, the poorer you become in the present.
But luckily, there's a psychological defense mechanism some people naturally possess, and it's called the sign effect. This happens when you feel the psychological pain of a future financial loss way more intensely than the pleasure of a future financial gain. It actually creates what we call borrowing aversion. You become terrified of debt because your brain so heavily weights the future pain of actually having to pay it back. It's a weird behavioral quirk, but it genuinely protects your wealth.
Which leads us into Section 5, designing your commitment devices. Okay, but relying on natural psychological quirks or just raw willpower has to be exhausting. Willpower eventually depletes. So how does a millionaire, practically speaking, apply this to their everyday life without totally burning out?
They don't use willpower at all, Rachel. They use structural tactics. They create what we call commitment devices. A commitment device is basically a structural rule that introduces deliberate, helpful friction between the impulsive doer and your money. So you physically lock your credit cards in a safe. You delete buy now, pay later apps from your phone entirely. You completely unlink your digital wallets from online stores. And you fully automate your investment contributions so that the money leaves your checking account before you ever even see it.
One of my absolute favorite historical examples of a commitment device is the Victor Hugo method. When he was trying to write The Hunchback of Notre Dame, he kept getting completely distracted by parties and socializing. His inner doer was winning big time. So what did he do? He took all of his formal clothes and literally locked them away in a chest. He left himself with nothing to wear but this giant, ugly gray shawl. Because he couldn't leave the house looking like that, he physically forced himself to stay inside and write his masterpiece. And that is exactly how you have to treat your finances. You have to lock away the tuxedo. It's also deeply about emotional connection. Dr. Brad Clontze's research shows that when people tie a vivid, visual, and emotional connection to their future goals, I mean like physically keeping a picture of the business they want to buy or the debt-free life they want to live right on their desk, their savings rate skyrockets by up to 73%. You literally have to make the future feel as real and as rewarding as the present moment. Now, before we reveal the final, absolute key to compounding your wealth, I need you to do something for your future self right now. Subscribe to Rich Tribe channel, like, comment, and share. Join the community of people who are actively choosing to build long-term, generational wealth. Let's move to our final point, Section 6, time is your ultimate asset. So Richard, we've talked about biology, behavioral economics, and all these commitment devices. How do these daily behavioral shifts actually translate into millionaire-level wealth?
It all translates through the pure mathematics of compounding and the undeniable fact that time is your ultimate multiplier. Let's look at two people. Both save just $200 a month. One starts at age 22, the other starts at age 32. Because of the rule of 72, which is just the math of compound interest, that 22-year-old doesn't just end up with a little bit more money. They end up in a vastly different financial universe. That 10-year head start, which was only enabled by delaying gratification early on, creates hundreds of thousands of dollars in pure, effortless profit.
Which brings us to this incredibly profound truth. Successful people do consistently what others do occasionally. Wealth is almost never the result of one dramatic, heroic financial decision. It is the invisible sum of thousands of small, everyday moments where your prefrontal cortex actually beat your limbic system. It's skipping the car upgrade, holding off on that designer watch, and quietly buying assets while absolutely everyone else is busy buying liabilities. It really all comes back to that classic marshmallow test from childhood. So the question we want to leave you with today is to really evaluate your own mental accounting. When you look at your very next paycheck, your next bonus, or even your next online shopping cart, are you going to choose the immediate satisfaction, or will you choose the second marshmallow for your future self? Because ultimately, the choice is entirely yours.